LBO model steps again. Sorry to go through this again. So first, we're going to make our transaction assumptions to understand the company, entry, exit, multiple financing structure. We're going to create a sources and uses table. The point of that is to figure out how much money you're bringing in, how much money is required, and also ultimately how much equity you need to put in to cover not just the purchase the company, but the fees. And then you're going to project the 3 financial statements without the interest expense, without the impact of debt. And we're going to adjust the balance sheet for the transaction. And then we build a debt schedule, which is the most complicated part. We're going to be looking at free cash flow, but also some other adjustments to figure out how much cash we have to either borrow or repay debt. And then we're finally going to build an exit waterfall, which basically distributes the proceeds between management and the sponsor and accounts for any options to finally figure out the IRR. And then we'll do some sensitivity analysis and some, it's good to have a downside upside base case scenario. We won't do that for this, but if you're answering this in an interview, you should always mention this, and should also always do this for like a more professional model if you have time. Okay, so with that being said, let's get to the case study. The case study instructions are over here. So I won't go through these in too much detail, but basically 9 times entry and exit, management rollover of 10%, options of 50% or 5%. There's a revolver 0.5 times drawn with a total commitment of 300 mil, 4 times LTM EBITDA, term loan 2 times LTM EBITDA mezz with a bit of PIK and cash interest. What's interesting here is we have an OID. OID is an original issuer discount. Basically, we're going to actually receive 2.5% less of the term and mezzanine loan that we're actually going to take out, but we have to pay the full amount. So like amortizes, the difference amortizes. And this would happen if interest rates changed, or maybe, the bank just changed their mind, or maybe that was just the original deal. They just wanted to do like that. So yeah, there's some other things here as well. But yeah, we're basically given the kind of the first year income statement assumptions, like the revenue. We know the EBITDA is 300 mil. And we're also, a lot of this is just held flat as percent of revenue. And then balance sheet assumptions we have CapEx assumptions. So we have everything we need here. This says 1 hour. I'll be honest, this takes at least 2 hours, if not 3. I don't know why. I don't know how people do that quickly, but let's do this from scratch. So first thing I like to do when I build a model is I remove grid lines. I usually start from like here, and I just type in, let's call this a 2-hour case study. I like to add a little, spacing because it could be useful sometimes for navigation purposes. And then I'm going to have the units here. And then first things first, we're just going to do the assumptions. Actually, yeah. So, sorry, I think the dollar sign goes after is better. Okay. Okay. So actually, the first thing I like to do is put in the years as well. So I'm going to put in the years here. It looks like the transaction is closing at 2012. So we'll just do 2012, and then it'll be 5 years. We're going to sell it in 5 years. I'll just add a little formatting. If you go to custom formatting, you can like do a lot of stuff with that basically. But what I'm just adding like a letter to denote what is actual and what is in the future. Okay, so I'm also going to fix frames here. This is really, whoops, maybe not right there. Sorry. I'm going to move this over here. There we go. And now I can get started. So I'll have assumptions. Okay, so let's list some of these assumptions in. I'm going to have both documents here side by side. If you have any questions in chat, if something doesn't make sense, just post in chat. I have chat on my other screen. Okay, so some of these are pretty straightforward. This is probably the most boring part of the whole thing, just typing in the assumptions, but it is important. Oh, another thing I like to do, by the way, is just to fix formatting purposes. Before I even do anything, I just like make everything the right format, so I don't have to like do that manually. So yeah, this is like a classic format. Usually, if you go to the bottom of custom, you'll find it. What it does, it's like if it's a minus, it just puts it in brackets, stuff like that. It's kind of nice. Yeah, there's a lot you can do with format. I'll try not to get too caught up in formatting because that's not the point here, but I think it's important to know this because investment banking, you're expected to know this. Like like adding an X, for example, after these is going to add a multiple. Like stuff like that's really useful to know. All right. So we got the entry exit multiple. What else we need here? I'll just type them all. Like they're just, it's not really an easy way to do this. Um, okay. I'm gonna go over what management options are later. You'll kind of see, but it's kind of like giving management 5% of the upside, basically, is how I would describe it. I might as well categorize it the exact way they do it. Like, if you can make life easier for yourself, just do it. That's what I say. Now that being said, I will I think I will change the order here a little bit because I think it's good to have the I'm kind of just curious what the actual enterprise value is. So we know that LTM EBITDA is 300. So 9 times 300 is going to be 27 million. Cool. So we know how much we're paying, or this would be 2.7 billion actually. That's what we're paid for this. I assume this is in millions. Let me double check. Yeah, it's in millions. Okay. Cool. Back to the financing assumptions. So financing assumptions, we got revolver at 0.5 times. And I think for this, yeah, I'll just do it in the order they have it. Actually, no, I'm gonna, yeah, I'll do it in the order. Sometimes it's just easier to do that. I'll format that later. This is the one downside of doing stuff from scratch. Is this part? It's probably the least interesting part because just me copying stuff. But it is important. Whoops. Okay, that's the revolver. Term loan. So the revolver is like a line of credit, by the way, if you didn't know what that is. Term loan's more like a normal loan, but you have to like pay it off over time, like, which is why there's usually mandatory amortization, is what I mean. Mandatory amortization just means repayment. So long story short, sorry, where am I? Yeah. Long story short, we're gonna have to pay 1% of the principal every year. In fact, we can actually find what the debt is in a second. Maybe not. I'll do that perhaps in the sources and uses. Okay, so actually I'll do it here because it's probably easier. So we're taking that 0.5 times multiplied by the LTM EBITDA. It's 150. And then here, I'm going to take the oh, an important thing to do when you're modeling, save up, which is what I'm going to do right now. I'm going to save this up. Let's create a new folder. We'll call this 2-hour case study. Scratch, Apex. And save up frequently because this thing could ref anytime. Also enable iterative calculations, which I just did. Okay, term loan, 4 times EBITDA. Okay, so we got 1.2 bill of term loan. All right, let's go on the last piece of debt, the mezzanine. So 2 times EBITDA. Let's calculate that. Curious what that is. Meanwhile, I like the mantra format as you go, so I'll be doing that. Oh, whoops, wrong number there. Format as you go, but also double check as you go, so you don't do stupid stuff like that, like I just did. Cool. just going to switch. I'll be switching between my standing desk. Okay, so hopefully you can still hear me. All right, so with the let's go back to the mezzanine here. This will get a bit more exciting once I'm done typing these assumptions. As exciting as LBO modeling can get, which is obviously very exciting because what else could be more fun? Okay, so there's two components of the mezzanine interest. Cash interest, so that's going to be 10%. And then the PIK interest. PIK, by the way, is like interest that is not paid right away. It stands for payment in kind. So you can think of it as like, if you didn't pay interest, well, what happens? You just owe it later, right? So you basically just like defer the payment of the interest to much later. But you'll see how it works. You still expense it. It's just not actually paid. Okay, the cash flow sweep. There's an OID. OIDs are pretty annoying, if I'm not gonna lie. But let's try doing them because why not? Okay. You don't often see original issuer discounts in case studies, if I'm going to be honest. So it's also not crucial that we go over that. But all right. So notice it says average balance. What I actually recommend is having a switch. When they say average balance, they mean interest. Like, is interest going to be an average of opening ending balance, or is it going to be a percentage of the opening balance? Having a percentage of the opening and ending balance makes your model circular. So what I like to do is interest as percentage of opening, let's say average balance. And then I like to create a little toggle. So over here to the side here, I'm just going to have a little yes and a little no. And I'm going to do what's called validation. So sorry, I got to fix my Zoom shortcuts because, it's silly. Zoom has all these shortcuts that interfere with Excel. And then it's like, why did you have to pick like the most common number, like things? Like, it's really silly. Okay. No more shortcuts for Zoom. Okay, good. So now I can do what I want. Oops, sorry. Okay, so yeah, so Alt VV is going to give me data validation. It's AVV, and then I'm going to go to list, and then I'm going to select what I want. So this allows me to do a little drop down box, just like a fancy way of, so now I can say, I'm actually going to start off with no, and then you'll see once I'm confident that my model is working, I'm going to change it to yes. Just avoid the model roughing out. Okay, let's keep moving here. Excess. Okay, so there's going to be some allocation. This is actually like a surprisingly complicated case study, even though it doesn't look like it, because the reason being is because it has all these little things that sometimes like you don't think, like when it says excess like allocated PP&E, normally you just allocate the excess when you like adjust the balance sheet. You just put it to goodwill, right? Because normally like you put in a bunch of new debt and a new equity and it's going to like mess up the balance sheet. So use goodwill to balance it, but they're saying no, use 15% of it on PP&E instead. And that is normal. So we'll do that. But okay, a lot of this stuff is just flatline for working capital. So I'm not going to put that. That's pretty straightforward. And then finally, income statement assumptions. So if you get a case study, this is what you should do too, as not exciting as this is. It's good to write down the assumptions because otherwise it's easy to make mistakes. But you don't have to write everything down. Like I'm not going to write like last home one's cost of goods sold. Right? I'm just going to write like stuff that actually is going to drive the future. So like DNA, yeah, like a lot of this is just not. Okay, CapEx, there's another thing. So this will just be model assumptions to call it. And there's clearly not much because a lot of it's just going to be held flat. So the actual model itself is pretty easy. It's more just like random little complexities here and there. Okay, so finally got the assumptions done. So that's step one. The next step, if you remember, is to create a sources and uses table. By the way, if I'm going too fast, too slow, just say it in chat. It's it's hard for me to gauge sometimes. Okay, sources and uses is not too hard to do actually. And the trick though is to do your uses first, because you want to figure out like what you're buying first before you even figure out where you're gonna get the money, because you have to figure out how much money you need to buy what you need to buy. So what I'm gonna do right now is another favorite shortcut of mine, Alt WN, creates a new window, allows me to have a separate window of the same model, so I can look at two things at once. I'm going to freeze frames on that as well, and then I'm going to figure out what, first of all, what we're buying. So we're buying this enterprise value, but if you remember in the case study, it said to refinance debt. What does that mean, refinance debt? Well, that means honestly, it literally changes nothing in the model, but it normally, if it didn't say that, I would just be like, okay, purchase price equals a 2.7 billion. But because they said refinance existing debt, instead, what I'm going to do is I'm going to have a line for refinance existing debt over here, as well as the purchase price. And we know that the existing debt is, I think it said 500 maybe. Yeah, sorry, this is one thing I forgot to put in the assumption. So I'm going to do that now. The existing debt is, I'll put it here actually. So we'll call the purchase price. So the purchase price is going to be a little bit less. It's, instead of being 2.7 bill, it's going to be 2.2 bill. But that's just because I'm also going to refinance existing debt. Once again, this literally makes no difference to the model. It's just, they just did that to see if you understood how to put that in a source and uses table. At the end of the day, it's the same thing. I'm dropping 2.7 billion for the company. I'm just refinancing existing debt. What does that actually mean, refinance existing debt? Like in theory, it probably means I'm going back to the same lenders and coming up, or just like, yeah, that's like the theory. So, but the point is, it doesn't actually change anything because we're given debt assumptions. So it's really just affecting the sources and uses. Oftentimes, PE firms will not refinance existing debt because they have their own lending relationships. So they rather just get new lenders. Okay, but moving on. What else we have to do? Fees. We have an M&A fee. They just told us straight up what it is, which is kind of nice. It's only 20 million. Like what? I mean, that's like 1%. I guess it's not that bad. And then we have financing fees as well. So financing fees are off of percentage of the debt. And in this case, they are, let me just double check the case study here. Oh yeah, it's only on the term and mezzanine loan for this case study. So yeah, important to read these carefully. So wait, did I actually figure out what it's a 2.5%? Okay, I didn't actually write that down. So I'm gonna have to write that down here. Term loan and mezzanine. What was it? 2.5%. Okay, so let's figure out the size of that fee. So 2.5% times the term loan plus the mezzanine. Great. So now we know exactly how much money we need to do this deal. I'm going to indent this, which is Alt H6. All right. So now that I have total uses, I can find total sources. This is like if you were buying a house and you're like trying to figure out like how much you needed. You take the house and you add up the real estate agent fees, right? And then you go back and be like, okay, well, if I'm buying this house, I know I can get the banks that I can get this much mortgage, right? So the first thing you do is put in your debt because that's like kind of, that's already calculated. I already calculated it. And then you figure out how much you need from equity to make this thing work. So we have 150 drawn, even though we have 300 total available. So that's like the total max for this kind of like line of credit like instrument. And then term loan 1.2 bill, and then mezz of 600 mil. And then we actually have two sources of equity. One would be from the sponsor equity, us, and then the management rollover, which would be whatever management is putting in, because management has to be incentivized somehow to not leave this company. So the way to do this, probably easiest way to do this is just calculate like a difference here, different amount of equity required. So the amount of equity required would basically be the total amount of money we have to raise, 2.7 bill minus whatever debt we're raising, right? So the rest has to be from equity. And then we can split the equity based off of the ownership percentages. So this 815 times the split here. So it's going to be 10%, and the sponsor is going to be 90%. So actually, before I do that, why don't I just add sponsor ownership? So there, now I can easily multiply this 815 mil by 90%. And I can do the same for management rollover. Great. So now I have this, and as you can see, all this adds up to 2765. So we're good for the sources and uses. This will be useful later on when we're trying to calculate IRR. But now let's move on to the next step. Are people following along? Is this like, I'm going relatively fast because, like, you know, I want to get this thing done. But can people put like a hands up if they're following along? Just like some kind of indication. Okay, cool. People are happy. Good. Okay. The three statements: income statement, cash flow, balance sheet. By the way, we will have a break in the middle of this, so don't worry. We'll have like a chance to, like, you know, grab a drink or whatever. But yeah, that'll probably be like midway through the session. Okay. And we may finish early. I'm trying to get this be relatively efficient. All right. So income statement. As we all know, if the common question, like how do you get to EBITDA? Like revenue minus COGS minus SG&A, right? That should be hopefully ingrained into you. And creating an income statement should also be ingrained into you, hopefully. Because it's always the same. Like it's always just this, basically. Okay, here we got a question. Alejandro, quick question. In a merger model, you usually have to make a purchase price allocation schedule to calculate goodwill. Do you not need to do that here? Yes, we do. I am not going to do that yet. I'm going to do that when I get to the balance sheet and I have to adjust it. But yes, you're right. And yeah, so I will do that later. And that is very important M&A models. That's a great question. Cool. Okay, so I'm just gonna keep going here. All right, so I think I need to fix my frame here so I can actually see what I'm looking at. All right, so we know that revenue last 12 months is 1,000 or 1 billion. I know that cost of goods sold is, I'm gonna make this negative because that way I can just add it. I highly recommend you doing that so you don't mess up the direction. But this also lets us figure out what the percentage is, and that's just gonna be held flat, obviously. And we already know the revenue growth, it's going to be 10%. This is a super, super simple model where like literally every year is 10%. Usually you're going to have a bit more complicated than that, but this is good for mechanics, I think, because it's more about mechanics today. So already, I'm already able to get to like a gross profit number, even just based off this info. I can calculate a gross margin. And as you can see, it's just going to be held flat every year at 40%, pretty much. Okay, so what else do we have to do? After gross profit, you know, these are like the variable costs, so to speak. SG&A, you can think of them as the fixed costs. So SG&A here, it actually doesn't tell us SG&A, but it tells us EBITDA. So we can back out SG&A. Sometimes case studies will do that to you just to trick you a little bit, but it's not too tricky. As you can see, we can figure that out pretty easily. And once again, this will be held flat because everything is held flat in this very otherwise straightforward model. And then we can get to EBITDA by summing gross profit, SG&A. Okay, great. And this should, in theory, get us a 30%, I think, EBITDA margin every year. All right, so we're down EBITDA, the big number, but we got to keep going. Of course, there's other stuff as well. So let's add D&A. As percent of revenue. So D&A is 20, they say. So it's just going to be flatlined as percentage of sales. This also should be negative because it's an expense. So basically 2% every year. Okay, so we got D&A. Now let's get what's after D&A? EBIT, D&A, EBIT, of course, right? EBITDA, I mean, now it's EBIT. You notice I do like a little margin thing I mean, I personally like doing this. It's actually a good like way to just make sure your model's working too, because all these should be flat, right? And they are, so that helps. And then now we're getting down to interest expense. We're going to leave this blank, as I said. This is a pre-debt forecast, and then, but that will get us the earnings before tax, and then we'll have tax expense, of course, and then earn net income, and that is basically the last thing. So I'm going to bold net income and bold EBITDA, the two most important things here. Even though interest expense is empty, I'm just going to fill this out. Tax expense, this is old, so this is back in the old days when the tax rate was 40%. Oh, rough. Okay. Which is so high. But this is the it just feels really high now. Now that it's like 26% now in the States, I would say. It's like 21% federal with 5% state on average. But yeah, it used to be 40% on average, which is horrible. But that is no longer true. Okay, next statement, cash flow statement. The reason I do it income statement, cash flow statement, and then balance sheet is because the first item in the cash flow statement is net income. Like, so it just flows, right? And what's the last item of cash flow statement? Cash. And then that's like the first item of the balance sheet. So I really recommend you go this order. It just like makes it's easier to follow, harder to make mistakes. And we're going to reverse the non-cash items, right? What are the three sections of the cash flow statement? Cash flow from operations. Actually, you know what? This is one of those annoying things where I'm going to get somebody pipe up right now. What are the three sections of the cash flow statement? I told you one. Or type it in chat if you don't want to pipe up. I'm going to give you 10 seconds. Okay, somebody got it. Perfect. Cash flow from operations. Thank you, Kyle. Cash flow from investing and cash flow from finance activities. We are going to leave the cash flow from financing activities empty because it is debt related, and we don't have the debt schedule yet. So we're just gonna do everything else. But we can, because all we gotta do right now here is reverse all those non-cash expenses. Luckily, they're not a whole lot. There's D&A, so that's easy enough. It's right up here. There will be PIK interest later, but let's not worry about that for now. PIK interest is that interest expense you don't actually pay. Actually, you know what? People find PIK interest confusing, so maybe I'll just quickly explain what it is. If you don't pay PIK interest, you can think of the interest accumulating and getting deferred, and then you pay it at the end. And PE firms will do this sometimes if they're trying to conserve cash to do like roll-up acquisitions. So this is what I mean. You're going to see this expense, but it's going to get added back because they're not actually going to pay the interest until they sell the company, basically. But of course, the debt balance is going to go up. So you'll see that later. Okay, what else do we have to do? Changes in working capital. So what does that mean? Well, looks like we have accounts receivable over here. Okay, so yeah, look, we have changes to accounts receivable, changes in inventory. Um, what other net working capital items do we see here? Accounts receivable, inventory, accounts payable, and accrued liabilities. So basically like four things. It's just not bad because it could be more too. Other things could be like changes in prepaid expenses, other current liabilities, other current liabilities. But we don't have those. Okay, so I think that's pretty much it. Changes, say cash flow from operations. Oh my God, there we go. Okay, the next step, cash flow from investing activities. I'm going to indent. I always encourage people to indent. It just like makes it look better. If you have, here's a rule with indenting. If you have more than one item, indent it. If you have just one item, don't indent it. That might sound trivial, but it does make it look better. Okay, cash from investing activities. Right here, there's only pretty much capex, capital expenditures. So we'll leave that blank for now. But we basically, it's actually pretty easy to calculate capex. So why don't we not leave it blank on second thought? Because I can just calculate it in a quick schedule. So I'm going to make a very, very simple capex schedule down here. Revenue capex as a percentage of sales, which is 3%, and then capex. And technically, I wouldn't even have to create a schedule. I'm just trying to, keep good form here. So if you can create a schedule, you have time to do it, then do it because it's just it's good form. People can clearly see what you're doing rather than poking around in your cells and trying to figure out that way. So yeah, as 3% of sales, pretty easy to figure out. And now I can link that up over here to my capex. And this will be negative because it's a cash outflow. Great. Okay. So, oops, there we go. Okay, now we have basically what we need to get to cash, free cash flow. Free cash flow is just going to be the sum of cash flow from operations plus cash flow from investing. In other words, it's basically cash flow from operations minus capex. Put another way, if you remember like the formula for levered free cash flow, it's like net income plus D&A minus changes in net working capital minus capex. That's basically the same thing, but we did it like we just did a statement because so it looks better. And we're gonna leave this blank for now. Let's just not even worry about it. But actually, I will type in the different items. The different items we're gonna be seeing are basically you can like borrow money. That's a source of cash, or you can repay it. It's an outflow of cash. And then of all the different debt we have. So revolver. It's probably plural. Borrowing, repay. Yeah, okay. Borrowing, yeah. So then we'll have term loan, and then we'll have the mezzanine. In addition to that, we're also going to have mandatory amortization for the term loan. As I mentioned, you have to repay 1% of it every year. I should just call it amortization. There we go. That's what it'll look like, and we'll keep it blank for now, but just in case you're curious what it looks like. Okay. So we've done the cash flow statement. Let's go to the balance sheet. So I have left some of this blank, right? Because I still have to create a net working capital schedule. So that's probably the next step as well. But before I do that, why don't I just fill out the balance sheet just for kicks here? You don't have to separate between current non-current assets, to be honest. It's just habit, I guess, that I do it. I don't even know. I mean, I guess accountants do it for reasons that perhaps are beyond me, but it kind of also doesn't really matter from a finance standpoint. Okay, so those are the assets. Oh my God, this is why you remove your F1 key. I just got a new keyboard. I haven't done it. That's why you do it, to avoid that. Oops. Okay. By the way, notice when I create a border, I always create a top border. Why is that? Because I can insert and this border moves down. So I always encourage you to create top borders, not bottom borders. Everybody creates bottom borders because they're like, yeah, because like, that's like logically how you would do it, right? But okay, um, so yeah, I'm just putting in some formulas, but nothing there yet. Okay, next section, liabilities plus shareholders' equity. As we know, assets must equal liabilities plus shareholders' equity because they must come from somewhere. They are either financed by debt or they're financed by equity. So let's start with liabilities. Um, so go liabilities, will current liabilities. And then current liabilities, you have accounts payable, accrued liabilities. Okay. So we got the current liabilities, we got the non-current liabilities, which are basically the debt. We have the existing debt as well. So I'm going to put that in, but we also have the new debt, revolver, term loan, and mezzanine. So just give me 1 second. Sorry, just give me 5 seconds. Okay, back. Great. So I think we'll probably take a break at let's call it 3 or 4:15 p.m. EST. Just so people don't fall asleep and people have time to like grab a snack. It'll be like I don't know, let's say 15-minute break. 15. Yeah, 15's like good. 15's enough for you to grab a snack. You know what I mean? Like if it's 10, you might be like shoving potato chips in your face or something, but okay. Total liabilities. Yeah. So this is just, the boring copying stuff down. Unfortunately, that is a part of modeling. Unavoidable especially when creating from scratch. Shareholders equity. Now, shareholders equity, people often, you'll see this broken down in public financials, like paid in capital and retained earnings and whatever. For the purpose of PE, we don't really care. Like we're just going to keep it as one line because it's more relevant for public, like yeah, like as a private equity investor, I don't really care. It's just because like it's gonna all get wiped out anyway. And you'll see what I mean by that. And then we have total liabilities plus shareholders equity. And then of course we'll want to check it. Okay, so we got all this, hooray! But let's actually fill out the first year. So let's do that right now, which is just coming from this side here. And of course, the first step is to make sure that the first year balances, because that would be fortunate if it didn't. Revolver. we calculate. Okay, so I'm going to bring up my other window here, my sources and uses, and I can actually. Oh wait, this is before the transaction. So actually, this is what I'm going to do. So for when doing a balance sheet, there's like a post transaction and a pre transaction. So what I'm going to do is actually create on the side here a pre transaction adjustments, and then a post transaction balance sheet. And the purpose of this is to basically look at what this would look like without the transaction. So remember that the transaction is happening at year end 2012, right? So this will be for 2012. It's going to center cross selection, always center cross selection, which is like alignment, horizontal center cross selection. Don't merge cells. Just don't do it. It's going to mess up your model. Okay. So this is the pre-transaction balance sheet, and then we're going to adjust it for the transaction. Okay. So let's see if this even balances. I'm actually going to just delete this stuff here so it's not confusing. Oh my God, this is I really got to take out this F1 key. It's gonna cause me an ulcer. Okay. Shareholders equity, 800 mil. All right, let's see if this works. The final moment, yes, it does. It balances. Hooray. You want to constantly be checking if your balance sheet's balancing. In fact, this is what I recommend. Have like something at the top. Oh, sorry, this is. I'm gonna create this check everywhere. Obviously, this check's not gonna work yet. I mean, it will for now, but like, it's not like the balance sheet's not done. But up top here, I'm actually just gonna be like, check, like straight up. Does this even work? And if this thing, as soon as this thing is not zero, I'm gonna stop what I'm doing, because you do not want to like do a bunch of work and then like be like, oh wait, my balance sheet doesn't balance, and then like want to, you know, just be really sad because suddenly you're gonna have to check everything and you have no idea what it is. Whereas if you just have this and you're constantly looking at this, as soon as it changes, you can just undo what you did, right? It just makes your life way easier. Okay, but let's talk about adjusting the balance sheet. And this is where Alejandro's question about the price allocation schedule is going to come into play here. To adjust the balance sheet for a transaction, what we're doing is, think about it this way. In fact, I'm actually just going to write down what we're going to do over here. We're going to put the first we're going to put in the new debt, right? So take out old debt, put in new debt. I'll put this in the same sentence. And then we're going to take out old shareholders equity, put in new shareholders equity, because we're basically buying the company, right? So we're going to, like, who cares how it was financed before? We are now refinancing it and putting in new stuff, right? New money. Okay, and that'll be from the sources and uses. Now, what about other things? Well, there is one thing. If you remember, we had a financing fee, right? So actually, that is technically, you're supposed to capitalize financing fees. So I'm going to add that in as well. So I'm just going to add a note here, capitalize financing fees. The reason you capitalize financing fees is because I guess technically the financing fee is the fee for the debt over the 5 years. And based on accounting rules, you're supposed to expense things as they happen, as the service is provided. And the service in this case is the debt. Whereas the M&A fee is different, right? The M&A fee is like the deal's done. So there's no like nothing to capitalize. It's already like the service has been delivered. Anyways, so we're gonna have to capitalize that, amortize it later. And then of course, we're also gonna have to adjust the cash balance. So this 50 is gonna change to whatever the minimum cash balance they wanted. And then what else do we have to do here? Oh yeah, we have to allocate the excess. So this is not going to balance after we do all this. So it's almost always an excess to the asset. Like there's almost always too much debt and shares equity after you put in the new stuff. So you have to like increase assets to match the increase in debt and shares equity. So you're increasing assets. Normally you allocate it to goodwill, but in this case, we're actually going to be. It's said to allocate 15% to PP&E. So only 85% is going to goodwill. Okay, so this is what we're doing. So hopefully that's clear. So let's do it step by step. The new debt. All right, well, let's take out the old debt first. Where's the old debt? It's over here. That's easy enough. I'm just going to throw a little minus 500 down there. It's gone. Okay, let's put in the new debt. What is the new debt? Oh, why did I create a third window? Okay, there we go. The new debt is revolver, term loan, and mezzanine. So easy enough. Copy these, toss them in here. Great. So we have the debt done. Having the sources and uses makes it easy. Now we're going to take out the old shareholders equity, put in the new shareholders equity. What is the old shareholders equity? Well, whatever is here, let's just get rid of it. Goodbye, old shareholders equity. But we have to add in the new shareholders equity, which is whatever we're putting in, which is going to be the sponsor equity, but also whatever management is putting in as well. And as you can see, it ends up being not like a huge adjustment. Like it's only, if you add this up, like this is 815, right? So it's like it was only 15 higher than what it was before, but that's fair. And some of these are just going to be like not, there's going to be no adjustments basically. Okay. Before I get carried away here, I'll stop getting distracted and get back to the steps. What is the next step? The next step is capitalizing financing fees. So as I mentioned, the financing fees have to be capitalized. We know what they are luckily. They're just right here from sources and uses. So easy enough for us to do that. And then we're going to adjust the cash balance now. So normally for LBO, if there's no instruction given and it says cash flow sweep, you can assume every single dollar is being spent to pay off the debt. No. So so like normally this could just be like -50 and then you just end up with zero cash. Now, in reality though, companies are probably going to want to keep some cash around because it's like kind of dangerous to not have a single cent, like, in case something goes wrong. So there's a minimum cash balance here. It's 25. So, it's easy enough to figure out what this will be. Or it should be like this minus that. There we go. Okay. So yeah, long story short, we end up with 25 of cash in the end. So now, of course, we're going to have a mismatch. And how are we going to deal with this mismatch? Because I made all these adjustments. Well, we're going to have to deal. The excess is going to be allocated to goodwill. As you can see, nothing is going to add up even after I I'll move this like down here. That I don't like that either. Sorry. It's weird that you can't like see if I do that, it like shows one person. It's weird. Anyway, okay. Back to this. Sorry. Yeah. So we're gonna have to allocate the excess. So what is the excess right now? We can actually like just calculate it. Like the way I'm gonna do it here is probably I'll do it like on this sheet here. So this is the same thing on this, but like I'm just gonna like create a, maybe what I'll do is I'll move this over a little bit and just create like a little schedule thing. It'll be a very simple schedule. All I'm gonna be doing is looking at the assets versus the liabilities plus shareholders' equity. Okay, so actually, so this is what I'll do. So one side will be adjustments to assets. The other one will be adjustments to liabilities plus shareholders' equity. Okay, so what are we adjusting in terms of assets? Literally just two things, right? So far, anyway. So I'm just gonna sum up those two things. And then the adjustments to the liabilities and shares equity is all this stuff here, right? Like it's a lot more. Plus the shareholders' equity adjustment. So let's just move this. So the excess, this is probably not the best way to do now that I think about it. Maybe it's okay. Here, this is what I'll do. I will just actually create some space and do it here. I'll be honest, when I do it, I often just like calculate it in the cell, but I'm realizing that that would be like really confusing if I did that. So I think it's better for us to show the steps. Okay. All right, so thanks for bearing with me there. All right, so hopefully all these steps make sense so far. Right now, as I mentioned, we're just allocating the excess to make it balance. So what is the excess? Let's figure it out. It is 14.45 that we need to allocate to either goodwill or purchase, goodwill or PP&E. We know that 85% is going to goodwill and 15% is going to PP&E. So where can we find that assumption? I think it's up here. So 100 minus 15% is 85%. So that's easy enough. Just take that, multiply by 85%. And then for PP&E, it'll be 15%. Great. So that's been allocated. And now there's some consequences of this, right? If I'm going to allocate stuff to PP&E, that means that there's going to be more depreciation as a result. As you can see, the lifetime of that depreciation is as 15. So we're going to have to you're going to see later, we're going to have to calculate that depreciation separately from everything else. By the way, you'll notice that I haven't actually put in the, I just know original issuer discount. I'm gonna do that after, actually. I don't want to like confuse you guys. But if we have time, I'll show you what happens when we apply the original issuer discount. Okay, see you later, Alejandro. Okay, but here we have the goodwill and the PP&E. So let's throw that in now into the adjustments here. And we have the PP&E. Okay, so let's see if that balances. And it does. And so yeah, this is the advantage of creating like a little thing like this. It'll help you prevent mistakes. And later I'm going to play with this as well. You'll see. But okay, but we got on the first step. We got the balance sheet to balance, and so that's perfect. We got the first year adjusted balance sheet adjusted for the transaction. So I'm going to just make like this year equal to that basically, because we've already calculated everything. So it's easy enough to just kind of copy and paste, just to link it directly to that. We have a working balance sheet. Great. So with this balance sheet now, I can kind of start filling it out. Probably the first thing I want to start with is net working capital. So let's do that. Net working capital, it's set to keep things flatlined based on like days sales outstanding, inventory days. This is one of those things that can be confusing at first, but once you get used to it, it's not too bad. So the current assets, once again, these are operating current assets. You're not going to be taking like cash or anything. It's just accounts receivable because that's like part of the business. You know, taking sales and credit, same with inventory. That's part of the business, like buying shoes in a shoe store, just part of the daily operations. Cash, no. Tax assets, no. Those are not part of the core business. You know, like they're not needed to run a business. They're just other things. So let's figure out first what the items are, and then we can figure out how to calculate them. So we are 5 minutes away from our break. Just heads up. And then we'll be taking a 15-minute break. If by chance we're not able to finish this, I think we are, but if by chance we can just continue at another time. I'm not going to go over time because I'm sure people have stuff to do. Okay, so net working capital is just current assets minus current liabilities. Changes net working capital. I actually like to, this is not really going to matter, but I'm just going to like, I actually like to get the change. Like most people will take this year minus last year to find the increase. I do the opposite. I take the previous year minus the current year. Why? Because then the direction of this is going to be correlated with the impact on cash flow because you deduct increases in net working capital. So like if net working capital goes up, it's actually negative for cash flow. So that's why I did that. Once again, it doesn't really matter because it's not going to drive anything. It's more just for display purposes. I'm going to put the two key metrics that drive net working capital as well as the days. If you want to be cute, you can figure out which year is a leap year. I don't care. So I'm just going to say 365. Yes, I'm happy to send the Excel. I will post it on Slack, which I think y'all have access to, right? Yeah, and I realize this is going pretty fast. Unfortunately, it's LBO model is like the final boss, right? When it comes to modeling, it's like the hardest kind of model there is. So it is hard to teach this in a concise fashion, to be honest. Okay, so okay, net working capital. So how is this done? Basically through ratios for a lot of them, like days sales outstanding is accounts receivable. That represents how many days it takes to make a credit sale. So like if you're like a shoe store and you accept credit cards, maybe it's like 15 days because like that's how long credit cards take to work. But if you're like B2B, it might be like 30, 60 days. Days inventory held, that's pretty straightforward. How long is your inventory held in the year? Days payable standing, how long does it take for you to pay suppliers? And then accrued liabilities will just be a percentage of sales. So how are we going to do this? Well, we already know the first year, luckily. So we can just link that. And then we're just going to we're going to calculate the ratios for that first year and then hold them constant. I used to struggle a lot with remembering what the ratios are. I actually still do sometimes, to be honest. But I'll see if I can teach you guys a trick to remember it. By the way, what I'm using to paste links, Alt ESL, super useful shortcut, Alt ESL. You can just paste any link you want directly. Day sales outstanding. So this is like how long does it take for your customers to pay you? So if you think about it, it's like if I wanted to figure that out as a percentage of the year, I would basically like figure out what my accounts receivable divided by revenue is. So like basically this is saying like, you know, whoops, 20% of my revenues accounts receivable. Well, okay, what is that in a year though, right? So I'm gonna undo the percentage thing. So that's how I like to remember it, and then I multiply it by the number of days because you found it for like as a percentage, but I want to know like in a year, what does that look like? Well, that's 73 days, which is 1/5 of a year, right? So it takes 73 days for your clients to pay you by taking accounts receivable divided by revenue multiplied by 365. Same idea here, right? Like of my cost of goods sold, what percentage is still like an inventory kind of thing? And like it's 17%, right? And then, what is 17% of a year? It's 61 days. So I hold on to inventory 61 days. By the way, I don't even know what this business does. I don't think it even says. So that's neither here nor there. But same thing finally with accounts payable. We're gonna do the same thing. Of my cost of goods sold, how much is accounts payable? How much do I owe to suppliers? It's 17% of a year. So we're actually gonna get, wait, did I do that right? No, I did. Okay, cool. Yeah, okay, I did. And then finally, accounts liability as a percentage of revenue. That one's a bit more straightforward. And now I'm just going to hold a constant. Okay, so now that we have that, we're just going to do the reverse, right? So whereas here I took, accounts receivable divided by revenue times 365, I'm going to be like, well, what's the other way around? It's going to be revenue times days sales outstanding divided by 365. Because it's kind of like, if I were to explain this, it's like, actually, I don't know. It's kind of hard to explain. It's honestly just algebra. It's just like the formula backwards. I don't know. Math is honestly one of the hardest things to explain because it's like how do I explain that? I don't know. It's just is what it is. Cost of goods sold times inventory divided by days inventory held divided by days. If you do this enough times, you kind of just remember it eventually. Or just like, like if you think about it logically, it's like you're taking the cost of goods sold, you multiply it by the days it takes, for example, in this case, to pay a supplier. But that's going to give you a really high number, right? And you're going to have to divide it by 365. So and then finally, accrued liability is a little easier because it's just revenue times 5%. Hold on, is that right? Why is it so high? That can't be right. Yeah, it's not right. So it's catching errors in real life. Okay, so the reason I knew this wasn't right, anytime you see a large jump like this, it's got to be wrong, right? Because I held a constant, so it doesn't make any sense that it would jump up so much. And so I think I was just trying to like talk too much, and I got distracted. And it should actually, yeah, it should actually be the same as inventory held because if you think about it, it's like 100. This is also 100, and they're both based off cost of goods sold, so it makes sense that the days would be identical. So now that looks a lot better, and I'm happy with that. Okay, so we've done networking capital, and then that can be plugged into the balance sheet. So let's try plugging it into the balance sheet. Okay, so it's 4:18. Okay, so let's take a break till 4:33 p.m. I know it's a random time. I'm gonna just put it in chat. I will just start at that time, basically, and we will come back. So I'm going to pause recording. But okay, so let's get back to it. Understanding that this is a little complicated, but okay. So where I was I was just about to paste link networking capital up here. That's what I'm gonna do now because I've gone through the trouble of calculating that. And then, okay, so what's the next step? I've got networking capital down. The next step would be let's do PP&E. So PP&E is interesting because we added a bit to it, right? But it's actually not quite as simple as just adding CapEx to subtract DNA, because we have the separate like DNA thing. So we're actually going to just create a DNA schedule here. And you'll see what I mean. It's a little more complicated than meets the eye, because we have the original DNA. We're going to call this depreciation and amortization. Let's just say DNA base PP&E. So this is like the original PP&E that we had before we even like did any adjustments. Then we have the DNA from the incremental PP&E. So that's like, we allocated some excess purchase price to it. So there's going to be even more DNA from that, but that's off a 15-year lifespan from the assumption. So this is like a 15-year useful life, and this is like a 2% of sales or something like that. So different calculations there. And the final one that people often forget is the amortization of the financing fees, because we capitalize that. So we're going to have to amortize that as well. So this will be a good start, I think, to calculate a more proper DNA number. So the number that we had before is going to change. So I'm going to take the number that we had before, this number. I'm just going to make that equal to this here. And then from there on, it's just going to be held constant as percentage of sales. So let's say revenue. And if you recall, it ended up being 2% of sales. So that is what we are going to hold the constant at. Okay, so that's the first part. Now this incremental PP&E, that's the PP&E we added because we basically added like 217, the part 15% of the excess purchase price. And instructions say to depreciate that over 15 years. If you can see here, it's the life of the incremental DNA. So sorry, 1 second. I want to just check something. This is recording, right? Yeah, it is. Okay. So the DNA for the incremental PP&E is a 15-year lifespan. We know the original amount. So how does that work? Well, let's just figure out what that actually might be. Actually, I'm just going to calculate it here because that might be easier. Actually, no, I'll do it down here. It's probably more appropriate. So here we'll say PP&E, incremental PP&E, which we know because we calculated that over here in the adjustments, or we calculated down here as well. So 217 is what it's going to be. And then 15-year lifespan, useful life, 15 years. 15. What's the shortcut for insert? Oh yeah, yeah, Alt IR to insert rows.
Thank you. I'm new to PC Excel, so I'm like, how do you do that?
Oh, good. Cool. So this is going to be the incremental DNA. 14. So let's put that in. It's going to be fixed. It's going to be the same every year. All right. Now, what about the financing fees? Well, we know that the financing fees have a, actually, let me check. What is the useful life of the financing fees? Probably should have wrote that down. 10-year life. So I'm going to write that down actually. Okay, so the 10-year useful life of the that means we're going to take the original amount of the financing fees. So that would be, I can take it from the source and uses, 45 divided by Actually, why don't I just type it here just so you guys can see it. So finance fees are 45 million, useful life of 10 years. 10 years. Here, 10. And it's going to be 5 every year. And now we have a new DNA number. This is going to be more accurate. And I'm going to put that in. Now, I'm not going to, I should have done it for the historical year. So that's where I'm not going to do it. But for the future, it makes sense. So let me plug in that new number. So yeah, as you can see, it actually doesn't. Oh, sorry, I put in the wrong thing. It should be this here. There we go. Okay, so now that I know DNA, the reason I did this is because not just to plug it into my income statement, but also to help me figure out the rest of the balance sheet, because I need to figure out PP&E. So I'm going to build a PP&E schedule. And if you think about it, PP&E is just like whatever you had before, plus CapEx, less any DNA. And in this case, it would be both the base DNA and the incremental DNA. And then we would get to ending balance. So the opening balance is just whatever PP&E was last year. So I'll just take last year's account, which is over here. I'm going to add CapEx, which is going to be from the cash flow statement. CapEx. And then I'm going to go less base DNA, which I have up here. The incremental DNA I also have up here. So voila, that is the schedule. And then the opening balance is always going to be equal to the previous ending balance. And then I can just carry everything forward. And I have a PP&E number here. This PP&E number I can basically plug into my balance sheet. Okay, so with that done, what is next? Well, what about the financing fees? Let's get that done, and then we can finally get on to the debt schedule. So this is going to be the financing fees. Honestly, we don't really need a schedule for this. So, because it's just going to be this minus plus like the amortization. It's just going to like amortize by a certain amount every year. So actually, yeah, let's just skip the schedule, because if it's that simple, then you probably don't need a schedule. As you can see, it's just going to go down over time. It's amortizing over 10 years, so it won't quite amortize fully, even by the time we sell it. Okay, goodwill is going to be held flat. And that's just pretty much always the case. Okay, now, and technically, when you write up PP&E, you create a deferred tax liability. So that's something we can go over too, I think. So let me explain what I mean by that. The government doesn't really care about the fact that you write up PP&E. Like they're like, okay, that's cute that you did that. And now you have a higher depreciation, specifically like this 14 million here, reducing your taxes. But the government's like, yeah, but we still want those taxes. That you can like write that on your financial statements that you present to your investors or whatever, but you still owe us tax. Like we're not gonna like let you expense this. Like this is really arbitrary. So they're going to be like, no, just give us whatever you owed us before. So in other words, what's called a deferred tax liability is created, which is like money you owe the government. Um, so we have to represent the fact that even though we put this in our income statement, in reality, we're actually going to pay the tax as if we didn't have this expense. So like think about it, 14 times 40% is like what, call it 6.4 million. That's like 6.4 million of tax we need to be paying every year that we're not paying based on this like calc here. So how do I represent that? It's going to be what's called deferred tax liability. So let's figure out exactly how much it's going to be. The way to calculate the deferred tax liability is actually, I'm going to do it up here. It's actually quite easy. This is the amount I write it up by. So over time, this will depreciate fully, right? So it's actually just going to be as simple as taking this multiplied by the tax rate. Because over time, yeah, it'll take 15 years, but it'll still depreciate fully. So sorry, where's the tax rate? Here it is. Okay. And I'm just going to double check actually if that's the way I did it in my other answer. I might not actually created a deferred tax liability in this one. It's funny. Yeah, I guess it's not like critical you do it. Like it's not going to like change a whole lot, to be honest. Um, Okay, let's jump back to this. I'm not going to worry about the detail. Let's do all this fancy stuff at last because some of it I need to review too. To be honest, I just wanted to teach you guys conceptually that might happen. But let's move on actually, because I know we have limited time. I want to just get this thing done before we do anything fancy. So we've actually filled out everything we can except for the debt schedule. I'll fill out shareholders equity as well. It's just going to be last year's shareholders equity plus net income. Because like it's like retained earnings, basically, kind of like an odometer of all the money you made. And I just want to make sure I added the right thing. I don't think I did actually. So I'm gonna. No, I did. Wait, plus D. Yeah, no, I did. Okay, we're good. Okay, and this isn't balancing. That's normal because we haven't put in the rest of the debt yet. So let's do the debt schedule. This is the most complicated part of the LBO. By the way, if you were creating a simple LBO model, all this balance sheet is not necessarily. You could just like stop here at cash flow, at free cash flow, and just start doing the debt schedule. To be honest, like this is more if they ask for like free statements, then you'll do it because like it's like another check to make sure your model is working. It's sometimes people like to see what the balance sheet looks like. But in theory, it's not necessary. You could actually just go straight to the debt schedule. And the reason being is all you really need to know is how much free cash flow you're getting. And that's what you're going to use to pay back the debt. So like, for example, like the revolver is the line of credit. That's like the highest, the first, if it's like a waterfall, the revolver's on the top. We pay this thing first. So why don't we start off with figuring out how much cash we have even to pay the revolver. So cash available for revolver repayment. And it's going to be a combination of things. It'll be free cash flow, which we've calculated. But keep in mind that the opening cash balance can also be used. So any cash that we had on a balance sheet could technically be used, but we have to keep a minimum cash balance as well. So if you recall, it's like 25 million. So we have to keep 25 million. So, and then finally, the last item would be mandatory amortization. That is the mandatory repayment of the debt. The thing is, if you don't repay this, you technically default. So that's why it's as critical as interest expense. And it's like, like when you buy rent a car or something, lease a car. I mean, they might make you pay like part of the principal as well as the interest. Same idea. They're just trying to keep you honest. Okay, so we'll put in the free cash flow. I only care about the future because this is like, it doesn't apply to the past here. Opening cash balance will be last year's cash balance. So it will be this 25 here. And I'm just going to hold that true for all these. Now, some of this is going to be blank because I haven't filled it in yet. So don't worry about that. We know the minimum cash balance is also 25, which makes sense. We're to the extent that we can, we only keep the minimum cash balance on our balance sheet because we want to be using all the cash to pay back debt. Now, these are, whoops. And then the mandatory amortization. Let's calculate that later. I'm just going to leave that blank. But this is just to give you an idea of how to figure out how to calculate the cash you have available to repay your revolver, which is going to lead to the next section here. So in this next section, I'm going to be looking at the actual payment of the revolver. So we know that the opening balance, I can take it from my sources and uses. It is 150, I believe. Yep. So we're going to start off with 150 drawn, which means that we'll have to borrow money if this is negative, right? It's actually not negative. The one way to make it ask ourselves, is it negative, is like do a min equation. Like if this thing is below 0, then this number will appear, right? But obviously if it's above 0, then 0 is going to be the minimum of these two numbers and it'll take 0 instead. So to show you what I mean, if I just made this negative 500, this is like, oh, that's below 0. Okay, great. Now there's one other thing we got to do. We got to add a negative sign, right? So if I was short cash this year, it's going to borrow 500 and it adds a negative sign because borrowing is like an inflow of cash. So I'll undo that. This is going to be negative for all the years, actually, because we always have positive cash flow. Sometimes you want negative cash flow because PE firms are like doing aggressive add-on acquisitions or something, or they're just short of cash for whatever reason. CapEx, maybe add-on acquisitions. Repayments. This one's a little complicated, so I'm going to do the first part. I always recommend going inside out for complex formulas. So I'm going to go minimum. Now, here's the thing. I can't pay back more than the opening balance, right? So if you think about it, like I have 181 million here, but I only have 150 in my revolver. So it's not like I can pay 181 million, right? I can only pay the amount of debt that I have. So this is going to turn out to be 150, and then I have to add a negative sign. But here's the problem with this formula. If I make this negative again, minus 500, well, this becomes, I don't want to do that. I only want this for payment to happen if I have positive cash flow. So I have to add another thing to this formula, which is going to say, make sure that the number is actually above 0. So I'm going to take it's max comma 0, right? Like what's the maximum of this number between that number and 0? Of course, it's going to be this, it is above 0, so it's going to take the opening balance number. And as you can see, all the debt is paid. So the revolver is paid very quickly in the first year. To be fair, I still have to fill out some stuff in the cash flow statement. So this probably won't be accurate yet, but actually, yeah. Now that I think about it, the cash flow statement's not really complete. I forgot to complete it. Let's do that. So hopefully that's not to jump around too much, but hopefully that gives you an idea of at least the revolver. We're gonna do the other tranches of debt, but I just want to jump over here to finishing the cash flow statement because I need to finish that. So it's actually pretty easy because all I need to do is figure out the changes in accounts receivable. I'm not going to know it for this year. And in fact, I'm just going to delete this year. You don't really need to build a cash flow statement for years where you don't have the previous year data, number one. And number two, you actually don't really need it for historicals. You really only care about the future because that's like when we buy the company. So I'm just going to do from here on, and I'm going to take the last year's accounts receivable minus current year. For current assets, always take last year minus current year because any increase in current assets represents a cash outflow, right? Like if people owe you more money, that's money coming out of your pocket. If you're putting more money into inventory, that's money coming out of your pocket. On the flip side, if you owe people more money, that's money you don't have to pay people. So I'm going to take this year minus last year. Oops. This year minus last year, because as it goes up, it represents money an increase in money that I owe people that I don't have to pay right now. And then same with accrued liabilities. Accrued liabilities usually refers to like wages, while accounts payable is more like for suppliers and stuff. Okay, so I filled that out. That'll just help me get a more accurate free cash flow number. I mean, it's still the same story. Revolvers paid off the first year. Okay, so let's think about the next tranche, which is term loan. I have to figure out how much cash I have available to pay for the term loan. So why don't we do that? So basically, it's going to be whatever cash I had available for the revolver repayment, and less so whatever cash I had available, and then whatever I borrowed or repaid. So in this case, we started off with this much cash, right? Like kind of cash that we could use, and then we ended up repaying a bunch. So we paid 150, which is all of it. So the cash available for the term loan is going to be whatever is left over. So after the first year, we have 16 mil left over, but in the future years, we actually have all the cash available to repay the term loan. So we're paying debt down pretty fast. This is pretty normal for a company that's growing 10% every year. That's like pretty good growth rate, especially if it's every year. There's one thing we have to account for the term loan. If you recall, there's mandatory amortization on this thing. So basically, first, let's just get the opening balance in here from the sources and uses. So we know we borrowed 1.2 bill. Okay. Oops, sorry, opening balance. Borrowings is going to be 0 just for so you can actually just put 0 here. You don't even have to do a formula because with a term loan, it's not like a revolver. You can't just borrow anytime. Now repayments, we do have to calculate because you can prepay a term loan. That's the thing. You can't for mezzanine, by the way, and that's going to be the next tranche. But so we're going to do the formula again. If you recall, it's the minimum of the opening balance and the cash available because we can't pay more than the opening balance. And then we're going to add, we have to make sure that it's above 0. So the cash flow is above 0 so that we can actually repay debt. And then we're going to add a negative sign because a repayment is a cash outflow. And I'm going to finish the rest here. And as you can see, we continue to pay down the term loan, but not quite paying down the whole thing. Now, there's one other piece that we need to add here. It's the mandatory amortization. The mandatory amortization is basically every year we have to pay down 1%. As you can see, it's up here in the assumptions. Term loan mandatory amortization. And it's going to be fixed. So every year it's going to be the same amount it's going to be just 12 million. And I'm also going to link that here. Because we have to pay this or else we default. So it's pretty important. So I'm just going to double check that. This is okay. Yeah, it is. Okay. I'm paranoid about not recording because when I started, I forgot to record. But it looks like it is. Okay. So that's a term loan. I'm going to calculate interest later. I'll show you how to do that. I just kind of wanted to get through the debt schedule first. And then I'm going to add the interest payment. So this, as you can see, there's a common pattern here. It's just a waterfall, right? Like whatever you paid before, whatever you had available before, we're going to look at it. Like, so this was the original cash available for the term loan, but then we had the actual like borrowings or repayments. And in this case, of course, it was all repayments. So that would be here. And we can get to the cap. Actually, you know what? This is not necessary for the mezzanine because as I mentioned, you can't prepay the mezz. So actually, that was a waste of time. We don't have to do that. Mezzanine is like, think of it as like risky debt. Often has terms that can allow it to convert to equity. In this case, we don't know that for sure, but oftentimes it does. So we're not going to have anything like that. But the point is here that the big thing to note here is that there's a cash interest expense, and there's a PIK interest expense. And this is going to matter because the cash interest expense is, what is it? 10%. So 10% here. While the PIK interest expense is 5%. Okay, so the opening balance for the mezz, we can find this from the sources and uses, which is over here, 600. And I'm going to add a new line called PIK accretion, because if we don't pay this PIK interest, it's just going to like accumulate on top of the debt. So and this is where I'm going to be using my toggle. If you remember, I had a toggle here. Right now it's set as no. So I'm going to say, if I'm calculating PIK interest expense, for example, or cash interest expense, I'm going to say equals if this thing is equal to no, let's say, then I want you to take it as the opening balance. The opening balance, it's not circular, because it's like if you do an average of the opening and ending, everything's circular, right? Like the interest affects your cash, which affects your which affects how much cash you have to pay back your debt, which affects your interest, which affects your cash. And then you mess up one thing and your whole model roughs out because Excel doesn't know how to deal with it. So it's I like doing this if I have time, because it just, I can switch it on and off if something gets messed up. And then I'll say, oops, times, oh my God, what did I do? Times, there we go. And then if it's off, or if it's on yes, then I will have an average of the opening balance and the ending balance times the interest rate. For all these, I should make them negative because it's a cash outflow. Great, so I have done that. Obviously, I need to fill that out before I can get those calculated properly. Great, so I'll fix some of these so I don't have to like redo this formula. I'll fix the row here, and the row here. So that way I can just copy this down here. So that, oh no, I just didn't quite do it. I have to lock this cell as well. Okay, there we go. So now it's I've calculated the PIK and interest expense as well. So the mezzanine is going to go up by the amount of the PIK interest. Sorry. There we go. And everything else is just going to be 0. We cannot prepay mezz. We cannot borrow mezz. Mezz is just like fixed as it is. And in fact, we have PIK, so it actually goes up. We owe more over time. And right now it's running off of opening balance. If I wanted to switch it to average balance, very easy. I just go like this, say yes. As you can see, it changes slightly, but it's so small that it's like a couple mil here and there, 1 mil, that it's not like a huge difference either. All right, so now we've done PIK interest. We also added the interest expense. Why don't we add the interest expense for the rest, and then we can kind of really finish this model. So if I were to, for example, add interest expense here, it'd be easy enough because I already have the interest rate, and I'll specify it that it's cash because these are all cash. So the revolver has an interest rate of 4%. Now you also notice there's some other things going on with the revolver, namely that let me calculate this expense first before I talk about that. And I'll do the same thing where I go equals if. It's like kind of annoying, but it does make it a lot safer if you do this. So you don't have to do this. Oh, I inserted this in the wrong spot. Whoops. What did I do? I don't know what I pressed there, but glad I'm back. Okay. Actually, I'm gonna. It would make more sense to put this below the debt schedule, or like the debt balance. I mean, so if so yeah, basically I'm going to look at equals if this thing here is a no, take the opening balance, multiply by the interest expense, and make it negative. Otherwise, take an average of the opening and ending balance. So opening balance and ending balance times the 4%. And of course, it goes to 0 once we pay it down. So what else we have to do, though? It mentioned some other stuff. There's a commitment fee. There's also like a max. This thing's not supposed to exceed 300. You can also build a function here to like make it such that so that it doesn't borrow if it's exceeding 300. I'm not going to do that right now because it never does. And I realize I kind of want to like just get to the answer first before we do anything fancy because I know this is a lot. Like, so you know, I feel like just getting the core concepts more important. But yes, but we do have to put the commitment fee though in. So let's put that in. So we know that the total amount, a commitment fee is basically a fee you have to pay on the revolver that you're not using. Seems like a strange concept, but hey, banks are going to try to make money however they can. So they make up these silly fees. I mean, it does make sense because they're holding that money for you. So there's some value in like what they're offering, I guess. So to do that, we're just going to figure out how much is unused. So it'll be 300 minus I guess we'll do an average of the opening ending balance here. And I could technically use a toggle here, I guess, but I guess I might as well be consistent. I'll use the toggle. So if it's no, oh my god, equals no, I'm going to take just the opening balance. So just this minus the opening balance. But if it's yes, I'm going to take this 300 and minus the average of the opening and ending balance of the revolver to figure out on average throughout the year how much I was unused. Right now it's on opening balance, so it's going to say 150. And we have the commitment fee here of, I think it was 0.5%. And so easy enough for us to calculate. It's just going to be that. Okay, so that's a bit of fees for the revolver. Let's do the last term loan interest expense, and we can finally link it to the income statement. Okay, so to link this to the income statement, or sorry, to do the term loan first. We know that the term loan interest is 7%. It's a little higher. And I'll do the same thing as it probably seems annoying to do this. So you don't have to do this, to be honest. It's just something I do. So I'm paranoid about things blowing up. Opening balance times interest, or the average of the opening balance and the ending balance times the interest, and make that all negative. Cool. So we got all these interest expenses now. So what I usually do after that is I like to then add up all the interest expenses, and I like to add up the debt too, just out of curiosity. I like to sometimes look at the debt over EBITDA. You don't have to do that, but it's just a good habit to see if, like, your company's like super levered or not. So that's the total debt balance for all those, I think. And then let's just do that. And just out of curiosity, what does the debt over EBITDA look like? This will kind of get you bonus points, to be fair, like for thinking about how the leverage is changing over time. And in real life, P firms definitely look at debt over EBITDA quite a bit. You can also do like interest coverage ratio, but like we'll not do that. You can look that up. Instead, let's add up the total cash interest expense and the total PIK interest expense. So cash is going to be those three things. I'm going to include the revolver commitment fee into the interest expense. And I think that is normal, because if you think about it, it's sort of like an interest expense. It's like paying interest for a line of credit you're not using, but you got to put it somewhere. So it's such a small number too. Like you may as well just put it in there. And then we have so those are the four things we're going to add. And then we're going to have PIK interest. There's only one here, so that's pretty straightforward. And so this kind of helps us look at the total debt. Okay, so now I can plug this into my income statement. I'm going to save this up. It's always a good habit. I would always save up with LBOs, because if it refs out, you can just go back to a previous version. And let's dump in some of the interest expense. And we know the cash. So I will also calculate total interest expense, actually, because in the income statement, we're going to be expensing all of this. So that's there. And then in the cash flow statement, we're going to add back specifically the PIK interest expense, because that is non-cash. And instead, the interest expense is going to increase the debt here in the mezz. All right, so we got interest in there. Why don't we add the repayment of the debt? So let's start with the revolver. That is going to be over here. So we basically just we actually don't repay it all in the first year anymore. As you can see, we end up repaying all of it by the third year, and that's when it starts trickling down into the term loan. And then by the third year, we start paying down the term loan. We never quite fully pay it down, but we pay a little bit down. And that's pretty normal. We also have some mandatory amortization over here. And we have basically no repayment of mezz, because that's generally not allowed. It's because mezzanine is junior debt, whereas like term loan senior debt, you can't prepay junior debt. Junior debt's like high interest, high risk, but like, you can't prepay it, because the investors are liking that high interest, right? They don't want you to like pay it when you can. When you can pay it is exactly when they don't want you to pay it. Because if you can prepay it, that means you have cash, and that's exactly when they want you to not repay it, because they want to make more interest. Anyway, so from here on, we can figure out the change in cash, which is going to be a sum of basically all these things in the cash statement. So I'm going to start with free cash flow, because that's like a sum of CFO and CFI. And then just going to combine it with cash flow from financing as well. And This is pretty normal, by the way. This looks, but let me double check to see if that is working correctly. Okay, it's because we haven't linked cash yet. So that's okay. You'll see this make more sense in a second. But we're gonna start with beginning cash and then ending cash. So beginning cash for 2013 is easy enough because I can just take it from last year's cash, 25. And the ending cash is going to be the sum of the change in cash and the beginning cash. And then I can just make this like, you know, I can just carry forward these formulas. And now I have to link the cash in the balance sheet to this ending cash number in the cash flow statement. Once I do that, I know this is working for a number of reasons. One, the change in cash is 0 every year. This is good because I know that we never fully pay down the debt. There's still some term loan left. So any excess cash we're making, we're putting it into the term loan. So it makes sense that the change in cash is 0 because like whatever cash we got, we're paying down this term loan. It also makes sense that we have 25 cash every year because that's our minimum cash balance. That's the minimum we need to keep on hand. So that looks right to me. Now it's not balancing yet, of course, because I haven't put in the debt. So this is the moment of truth. And I make no promises because it's always a mystery if things are going to balance or not. Oh, sorry, that's not the right because I might do stupid stuff like that. What I just almost did, mislink something or something silly like that. It's so easy to make these silly mistakes, and then you're like, you spend your whole like a whole 45 minutes just being like, what did I do wrong? And okay, I literally keep doing that. I got to stop doing it. I normally put that thing below it. That's why. So I am doing this in a slightly different way than I usually, but I think that that looks a bit better. Okay. Ah, look at that. Beauty. See? And this is what you want, okay? Because I was gonna be embarrassed if it didn't bounce, but it did bounce. Anytime it bounces, save up. Okay. That is in essence a 3-statement model. The things I haven't done yet are put in the deferred tax liability and do the original issuer discount. But honestly, these things are like kind of whatever. You don't really need to do them. I mean, you should if you have time, but let's get to an IRR first, and then I'll decide if I want to be fancy and do this fancy stuff. And partly depends on what you guys want to do. I mean, it's just okay, but let's figure out how to get IRR because that's always fun, right? What was the whole point of this model? Well, this is the point. To figure out IRR, and we can basically this will be like the last year EBITDA, so it would be 2017 EBITDA, which is this is very ancient. So obviously that was 5 years ago, but let's pretend that's the future. Exit multiple of 9 times, and I can find the enterprise value. Now we got to get equity value. Quick. Okay. I don't know if any of you are even still listening here, but how do I get to equity value? Somebody tell me quick. You have 10 seconds in chat. Partially a test to see if anybody's even listening right now. Okay. Nobody's speaking up. So to get equity value, you subtract debt, add cash. That's pretty much it. So let's do that. What debt do we have left? Well, that's why I calculated the total debt here. We have about 1480 at the end, and we're gonna also add any cash that we have left. So that would be from the balance sheet. We have 25 cash left at the end. I'm also gonna have to add cash from options exercise. So you're gonna see what I mean by that. This is like balance sheet cash, because we do have some management options we have to account for. But this will get us to equity value. This is like, think of this as like the pie to be split. You know, this is what we're getting after we sell the company. And then we have to split the proceeds. How do we split the proceeds? There are options. So that's what makes it a bit complicated. Otherwise, we would just split it 90-10. But because they're options, we have to figure out how much the options, like what that looks like. So the best way to do this, I find, is just to pretend like, let's say like each share costs $1 million. So if that's true, then sponsor. So just pretend these are shares for a second. If these are shares, then if you remember how options works, right? If I give if I say 10%, 5% options, well, what does that mean? That means 5% of all of these two things here, basically, are going to be created into new options. So what happened there? That was weird. There we go. So it's like as if I just created new shares here, and now there are more shares, right? So this is like classic dilution. Now we can figure out percentage ownership pretty easily. And as you can see, it's been diluted, right? We used to own 90%. Now we own 86%. Management used to own 10%. Now it's 9.5. And now the options they're getting a piece, right? We give these options to management, once again, just incentivize them. Like if you perform, hey, you're going to get a little extra and you're going to get more in the end, right? So that's the whole point of these options.
Would you like
What is it?
later sensitize it by any chance, or?
Yeah, we can sensitize this
Okay.
after. Yeah. Great question. So, okay, so let's figure out the time to split the pie, right? So, what do I call this? Let's just say proceeds. Yeah, proceeds. All right. This is it's a good time when PE firms get paid. All the partners are happy. A lot of people get paid in carry, so sometimes when this happens, people are getting like $1 million paychecks. It's pretty nice. So we're going to simulate that here. What does that look like for folks? Well, the pie is getting split based off what we just calculated. And as you can see, the total is equal. So that's a good check. But the sponsor, long story short, is getting 2,480. So now we can finally calculate the IRR because we know exactly how much the sponsor is getting. Let's do a little calculation here then. So call this IRR. It's funny, you do all this work for this model and you literally just like, it comes down to this like one number. Like it's kind of ridiculous, but hey, that's finance. It is what it is. It all comes down to this magic number. So what is the cash? How much did the sponsor put in? We know that from the source of uses. One of the reasons we do that, we know they put in 734. We know that there are no dividends or anything that happened in between. So it's really just the sale. As we can see here, we have an IRR of 28%, pretty good. That definitely passes the 20% threshold. I'm also going to add the multiple capital, which is just like how many times your money did you make? And they made 3.4 times their money. So that's pretty good. This is a deal I would say yes to. Of course you would. The company's growing 10% every year. And you're like levering this up like a decent amount, right? You're throwing like what, 6.5 times debt on it. Yeah, of course it's going to have a high return. I like to actually just like throw this up. Not everybody likes to do this, but I like to do this. Like I just have it like here, just so like I can see it constantly. Because when I'm messing around with the model, like then I can like just be like, oh, how did IRR change or how did this change? The order of this, by the way, is probably not ideal. I kind of did this just, without thinking too much about how to order the stuff. Like in past firms I've worked in, they usually have the like financial statements and then the debt schedule and then the exit waterfall and then all this other stuff, right? I mean, it's pretty easy to move, right? If I wanted to move it, I could just be like Control X, insert. So I'll move it just to make this look a little better. It is normally like probably like here is probably where it should go. And another thing you can do to make your model easier to navigate, just add X's at each of these things. I probably should have done that initially. I don't know why I didn't do that. It's one of those things that I learned in investment banking training that I never did. And then as I was coaching, people were like, shouldn't you do this? I'm like, yes, that's what I was taught. I just never do it. And I'm trying to get in the habit of actually doing what I was taught. Like, sometimes you skip steps and so but I guess it is useful, right? Now I can be like, oh, look at me fly through this model like a pro. Okay, what else? What else? No, and you can also like to make it look less, annoying. You can like make make it so it's not even visible. Like, you can't even see it. What X? Okay, so we have the IRR. Let's talk about sensitivity because that is important, and it's one of those things that people will skip if they run out of time, right? But if you have time, it's really good to do because very sensitive to this stuff. What do you always sensitize? Entry and exit multiple. That's the first thing you sensitize. That's easy enough. I would usually put, I think the entry probably here, and then the exit. Let me just double check. That's how I did it here as well. Did I even create one? Oh, I did. Yeah, that's what I did. Yeah, entry over in the rows, exit on the columns. And let's just create a little space so we actually have can put in the different things. So it was 9 times was the thing, but we can like just have like 8, 7, 10, 11, and same over here. We'll do the same here. Add a little border. Okay, so how do I sensitize stuff? If you're doing a table like this, you want to like this top left corner here, you want to go make it equal to whatever you're sensitizing. So, or I mean the output, I mean. So this is the output. The output is IRR. We want to see how IRR changes. I like to make this white, as many people do, and then that way you don't have to see it, but it's still there. So then I'm going to select this. I'm going to go, and notice all these are hard coded. Do not link these things because otherwise Excel will get confused. Okay, sorry, that was a little bit fast. I go Alt A W T. Okay, slower. If you want to do mouse, data, what if analysis, data table, right? So however you want to do it, I'm so used to the shortcut that I just do it without thinking. Okay, so when this is row, it's talking about what's on the row, which is sometimes confusing, but not like these rows. So like this, the exit multiple basically. So let's find the exit multiple. It's just actually right here, so it's easy enough. And the entry multiple, which is the columns here on the column, I should say, is over here. Now I got to press F9 a few times. And then of course I got to make this percentages. And the way you know this is working is that if this middle one, which is like, our main deal, 9 Xing and 9 buying 9, it matches this, then you're on the right track. And as you can see, if I exit higher, it's going up. Logically, this seems to make sense. Sometimes it's good to just, oh, I stupidly didn't, I did that. So let me fix that. There, now it's 100% right. So that's the most common sensitivity table. You can also sensitize all kinds of stuff. Like you can sensitize leverage. If you're sensitizing one variable, it's a little different. It's still really useful though. I would highly recommend it. So like, let's say I'm going to sensitize the amount of mezz that I use. Because if I were to reduce the debt, I'm not going to sensitize more debt. You know why? Because this is 6.5 times debt is a decent amount of debt already. So I'm actually just gonna like this is very common too. Like I'm gonna have it like where this is like the base case, and then I'm gonna have like 1 and then 0. Like what happens if we just don't have any uh so I'm gonna say like mezzanine. And to be honest, it's like a lot easier to just sensitize one. You like it's because you can only really you got to pick one piece of debt. Like you could sensitize different pieces of debt too, but just be realistic and be like, okay, realistically, what would they actually reduce? Probably the mezz, right? Because it's the most expensive. So what happens if we take out some mezz? Here, because it's just one variable, I'm actually going to put the IRR over here rather than the column. I'm going to put it like in this row because it's one variable. So I'll make that white again. And otherwise, it's similar, except it's just one variable. So I'm going to select this little table here. And I just care about the row. There's only stuff on this row, and it's multiple EBITDA. So it's this I'm sensitizing. And if my model flows, if everything's being driven by that, which it is for that mezz, it should work. So let's see if it does work before I say it does. And it does. So as you can see, this is the base case. I always like to put a box and bold it, the base case. As you can see, like, yes, if we didn't have any mezz, it kind of be more like a normal deal, so to speak, where you're kind of just making 20%. It's kind of interesting to see. You can sensitize anything you want, really. Like you can sensitize revenue growth. Like if you wanted to do that, this 10% thing, right, is driven by just one thing, right? Or oh, I didn't even like link it. That's so silly. Okay, I need to link this. This is why it's important to link things. So if you do want to sensitize stuff, okay, so now it's everything's being driven by this. So if I say this goes up by 1%, you know, what happens? So how do I do that? I'm going to create a little box here on the side called sensitivity. And I'll just, what I like to do is I just like put a 0, but I like to, you know, put a box around it. Maybe I'll just leave it like that. Maybe what I'll do is I will format it such that it, wait, I know I do a lot of formatting. It gets ingrained with your investment banking. It's like, even in private equity, believe it. I thought when I went to private equity, people would not care about formatting anymore, but they're still like, yeah, formatting. You gotta like, if it doesn't look good, it's probably not right. You're like, okay, I guess that's how finance is. Anyways, you just like get used to, and you get used to the point where you can't do things not formatted anymore because you just have this like weird feeling down your spine. You're like, this is not how I learned it. Anyways, once again, I'm linking IRR to, because that's like my output. And this is going to be actually, you know what, rather than doing the sensitivity thing, it's probably easier to do this way now that I think about it. I did the sensitivity thing because you can like make this equals 10% plus whatever. And that's really good when you have different revenue growths every year. So if I had like this, just pretend these are percentages, they're obviously not, but it would be hard to like pick one variable, right? Because every year the revenue growth is different. So what I would do is I would make each of them equal to whatever number it is, plus this like random box that I just created, right? Like say this. And then what I would do is I would sensitize this number so that if I increase this, if I had this like equals 9 plus, you know, whatever, suddenly, okay, this is a bad example because none of these are actual percentages, but let's just pretend they are for a second. So like, yeah, if this changes, like everything changes, right? Oh my God, why did it not change? Oh, I forgot to add it again. Sorry if this is confusing you, but my point is here that I'm like adding this right now. Wait, yeah. So yeah. So whatever I change here, like if this goes higher, right? Just don't worry about these numbers. There's really random. And so I could sensitize this number in my thing here, right? Like I could make it so that the variable that I'm sensitizing is this, and it'll automatically see what would happen if like these numbers went up or down. So anyways, that was my long explanation of how to do it if you have multiple, but we only have one here. So it actually makes it easier. So I can just like sensitize that particular variable because it's like just one assumption. And let's go up by like 2.5%. Like I think that's like a good, interesting amount to do it by. This will be the last one I sensitize. I think you guys get the point. Like you can sensitize anything. You can sensitize the margins. I'm not going to do the margins because I feel like you get the point. But once again, I'm going to just pick that variable, hit OK, F9. And then as you can see, the base case is this. It is pretty sensitive revenue growth. Like if we had revenue go down by 2.5%, it would be, and I could have done this with more, to be fair. Like, why don't we do with more actually? Because it's kind of lame right now. Let's add another. Just to make it more interesting. Just to show you how important revenue growth is in an LBO. Always press F9. Don't freak out if it doesn't work at first. Wait, what the? Let's try that again. I don't know why that didn't work. That was weird. I know what it is. It's because I have to delete this entire table. Okay, I'm kind of wasting time here, but you get the point. Yeah, I'm just gonna delete these rows because I think it like the problem with data tables is if you try to rebuild where you just built it, it like gets confused. It's really silly. It's one of those shortcomings of Excel. So you almost just have to like delete what you just did and then do it again if you're like trying to change up stuff. So sorry about that. Okay, let's try this again. So I'm going to select the revenue growth variable, press OK, press F9. And now it should work once I make these percentages. Yeah, see, now it's working. So you can see like if this is 5% growth, this LBO suddenly isn't like, it's not even worth doing anymore. That's how important revenue growth is, right? Like if it's 15%, this thing is nuts. It's like return like nuts. So yeah, okay, I think that's enough for sensitivity.